Let's be honest, one of the toughest parts of trading is figuring out which way the market is headed. So today, we're going to stop guessing. We're going to build a real system.
You know that feeling, right? You're just staring at a chart, your stomach's in a knot, and you're trying to decide if you should buy or sell. Making that wrong call? Man, it doesn't just hurt your account. It really shakes your confidence. What if we could just get rid of that guesswork?
Well, that's exactly what we're about to do. I'm going to walk you through 3 super practical, powerful strategies. The whole point is to filter out all that market noise and give you a much clearer signal. No more throwing darts in the dark.
Okay, so to build this system, we have to start with a tool that a ton of traders use, but a lot of them use it wrong. It's called the Super Trend Indicator. And yeah, it sounds great and it's simple, but if you use it all by itself, it can be a real trap.
You can see why people love it, right? It's so easy to read. The line on your chart turns green, that's your potential buy signal. It flips to red, that's a potential sell. It's clean, it's instant, and that's exactly why it's so popular.
And look, let's be fair. When the market is really moving in one clear direction, up or down, the super trend is amazing. It's fantastic at grabbing onto that momentum and keeping you in a winning trade for the ride. When it works, it really works.
But, and this is the big but, its greatest strength is also the key to its biggest problem. If you just blindly follow its signals, you are going to get into some serious trouble.
So here's the issue. Sideways, choppy markets. When the price isn't really going anywhere, the super trend just goes crazy. It flips back and forth, green, red, giving you a ton of false alarms. This is what we call whipsawing. You end up buying right before a dip and selling right before a pop. You're basically just buying high and selling low over and over. It's just a fast way to bleed your account dry.
So what's the answer? It's not about finding some magical, perfect indicator. Spoiler alert, that doesn't exist. The real secret is to combine good indicators, to make them work together, to confirm each other, and filter out all that noise. Let's see exactly how to do that with our first strategy.
Now, this first strategy is beautiful in its simplicity. Instead of just using one super trend, we're going to put 3 of them on the chart, each with slightly different settings. This creates a really strong confirmation system, all using the same basic tool.
Okay, so here are the settings you'll need. You're going to apply 3 separate super trend indicators. The first one you'll set to a 12 period and a 3 multiplier. The second one will be 10 and 1, and the third will be 11 and 2. By tweaking these settings, we're essentially making each one a little more or a little less sensitive to price changes. They'll react at slightly different speeds.
And here is the simple rule that makes this whole thing work. You do nothing unless all 3 lines are the exact same color. If you've got 2 green and 1 red, you wait. 2 red and 1 green, you wait. You only, and I mean only, consider a trade when all 3 are in total agreement. This is how you stay out of that choppy mess.
All right, let's look at strategy number 2. This time, we're going to combine 2 totally different kinds of indicators. This is going to give us both a short-term picture and a long-term perspective on what the market is actually doing.
Here's how it works. We'll use our standard super trend to spot that immediate short-term momentum. But then, to make sure we're not just swimming against the tide, we add a 200-day exponential moving average, the EMA. Just think of the 200 EMA as the big, slow-moving river showing the main direction of the market. The super trend is fast, the EMA is slow. When they agree, that's a powerful signal.
And the rules here couldn't be clearer. If you're looking for a buy trade, you need 2 things to be true. 1, the super trend has to be green. 2, the price has to be trading above that big 200 EMA line. For a sell trade, you guessed it, just the opposite. The super trend has to be red, and the price must be below the 200 EMA. This one little filter stops you from buying in a long-term downtrend or selling in a long-term uptrend. Simple, but so effective.
Okay, for our third and final strategy, we're bringing in another classic indicator to act as our filter. This one is called the Ichimoku cloud, and it gives us a really cool visual way to make our decisions. So we're going to pair our super trend with the Ichimoku cloud, or Kumo as it's often called. The best way to think of the cloud is as a zone of agreement or disagreement in the market. When the price is stuck inside the cloud, things are uncertain and choppy. But when the price breaks out, either above or below it, that's a sign that a real trend might be starting. So the rules are really straightforward.
For a buy trade, you want to see that green supertrend signal, but you only pull the trigger if the price is trading clearly above the cloud. For a sell trade, you need a red supertrend signal, and the price has to be trading below the cloud. If the price is anywhere inside that cloud, you just sit on your hands and wait for a clearer opportunity.
And here's a little bonus tip with this one. The cloud is also great for managing your trade. Let's say you entered a trade when the price broke out. If you see the price start to drift back inside the cloud, that's a huge warning sign. It tells you the momentum is dying down, and it might be a really good time to think about taking your profits and getting out.
So there you have it. 3 different rule-based systems. Every single one is designed to do one thing: take the guesswork out of the equation by forcing you to wait for confirmation before you put any money on the line. Let's just put them all together for a quick review.
So here's your cheat sheet. The triple supertrend uses 3 of the same indicator. And the rule is simple: they all have to agree. The moving average filter combines short-term and long-term views, making sure you always trade with the main trend. And finally, trading with the cloud uses that zone of agreement, telling you to only trade when the price breaks free.
Look, at the end of the day, this is the most important thing to remember. Good trading is not about predicting the future. It's about having a disciplined system, knowing your exact entry rules, and then having the patience to sit and wait for the market to give you a signal that's worth taking. It is all about waiting for that confirmation.
Each of these strategies gives you a clear roadmap to move away from just guessing. They give you a real framework for making smarter, more confident trading decisions. So the only question left is, which one are you going to dig into? Which strategy are you going to take, backtest, and master first?